Mr. Hemraj, you'll have to unmute yourself. You have to unmute yourself.
Good evening, all the participants and my chartered accountant colleagues. Myself, CA Himra Satyanarayan Joshi, and I am moderator for today's session on National Pension Scheme. Friends, I am indeed delighted to welcome you for this important session on NPS, which is organized by Committee on Financial Markets and Investor Protection, which is CFMIP of the Institute of Chartered Accountants of India. Generally, a person starts earning at the age of 20, 25, roughly, or maybe 22, 23, okay? And he keeps on this process till the age of 50, 55, or maximum, say, 60, 62 years. However, the expenditure continues even after that. Most of the time, it is observed that the expenses increase after this point of time due to various reasons like health issues, family responsibilities, increased cost of living, provisions for emergency, and so many other reasons. To ensure that, it is very important to have proper retirement planning, and National Pension Scheme (NPS) is one of the important tools to complete these steps. Launched in year 2004, National Pension Scheme is also now picking up its momentum. The latest asset under management is close to 8.8 lakh crore and is expected to cross the mark of 9 trillion by March 2023. The number of subscribers is roughly 6.14 crore, out of which the subscribers of Atal Pension Yojana are nearby 4.45 crores. Having said that, this is not the end of the journey. The journey has just started. If I talk on the coverage side, with so many subscribers, we have just covered 3.7% of our total population. Of course, the number has increased in last 5 years from 1.2% in year 16-17, but there is still a big gap that needs to be traveled. If I talk on the asset side, the asset under management of the pension business or pension class represent roughly 3.2% of our GDP. If I compare with other countries where such assets are roughly 100% or 70% of their GDP. So if you talk about on the asset side as well, it is a big gap that needs to be covered. And we, chartered accountant, plays an important role being a partner to the national building for completing this important journey. Hence, to discuss this important topic, I have with me CA Charanjot Singh Nanda, who agreed on our request to deliver his keynote address on this important session. Let me introduce Mr. Nanda. Of course, he does not need any introduction, especially for CA and professional fraternity. He's a well-known face, a well-known professional. He's currently Central Council member of 25th Council and chairman of Committee of Financial Market and Investor Protection. He is also chairman of Digital Accounting and Assurance Board of ICI, Committee on Information Technology of South Asian Federation of Accountants, which is SAFA. He has held many important positions as chairman, vice chairman, or member of various committees of professional bodies and regulatory authorities, including that of Securities Exchange Board of India. He was chairman of NIRC of Institute of Chartered Accountants of India in year 2002-2003. He has presented many sessions, both technical and non-technical, at national and international level. With this brief introduction, I invite Nanda sir to deliver his keynote address. Over to you, Nanda sir.
Thanks a lot, CA Himraj Joshi ji, the moderator of today's session. We also have Mr. Ranbir Singh Dhariwal, who represents Max Life, and Dr. CA Pinky Agarwal. Both of them are the speakers of the day. I take this opportunity to welcome you all. Ladies and gentlemen, you are all aware that the Institute of Chartered Accountants of India was set up an Act of Parliament way back on 1st July 1949, when the most important document to the democracy, the Constitution, was not adopted. All of you are well aware that the Constitution to this great country was promulgated on 26 January 1950. The pertinent question that arises is, what prompted the Constituent Assembly to set up an Institute of Chartered Accountants of India when its own democratic setup was in place? The answer is very candid, very simple, very forthcoming. They were looking for a disciplined band of soldiers to steer this country out of confusion. And ladies and gentlemen, we are there to serve you. The Institute, under the aegis of the Financial Markets and Investor Protection Committee, holds so many such programs. And today's program is one in the same line. Yes, National Pension Scheme. You are aware that Social Security is not that rampant in India, and to make that system robust, the government is always ensuring to bring in people into NPS. National Pension Scheme ultimately helps a person to invest money at his youth and utilize it as a pension at the later parts of his life. Yesterday, I was at a conference of Confederation of Indian Industries in Mumbai. The discussions were largely on liquidity and its impact on the economy. When we spoke about liquidity again, the question of people investing, people saving, and ultimately taking the benefit of that arose at a larger number. You're all aware that yesterday there was an announcement that long-term capital gain on tax-saving mutual funds was withdrawn. Even there were some changes into the security transaction tax. Earlier, a person who transacted and made sales of 1 crore in option market had to pay 1700 as STT. But from 1st April here, we'll have to pay 2200 as an STT. So these ultimately things, we were afraid only on one issue, that liquidity should not go dry. But assets of close to 9 trillion, which are being managed by NPS authorities, is something which is a shot in their arm. We would request the panelists to discuss how this would ultimately be imperative for chartered accountants to advise their clients and their future further family members or people who are a part of their family, so that they all make National Pension Fund a part of their life. Ultimately, investing in right direction would go a long way in making peaceful lives of the citizen of India. I would not speak much. I can see both the speakers here in full tone, but I want to tell that this profession is on high note. People have now started coming back to profession in all spheres. I am reminded a couplet in this regard which says, "Dete na the jo jawab, unke salam aane lage. Dete na the jo jawab, unke salam aane lage. Waqt badla, to mere neem ke ped par aam aane lage." So, ladies and gentlemen, you are now reaping the benefits of the great work done by your forefathers and forebears. And ultimately, financial market, capital markets are areas where we have gone a long way to educate our members and educate the public at large. The Committee for Financial Markets and Investor Protection holds certain post-qualification courses, certain diploma courses. So I would request all of you to be a part of this board, this committee, and contribute for the well-being of this nation and taking our institute, the Institute of Chartered Accountants of India, to unprecedented heights. Thanks. I return back the dais to Shri Hemraj Joshi ji to invite the speakers, and I wish this conference, today's webinar, a great success in times to come. Thank you. Thank you so much.
Thank you, Nanda sir. Your word of wisdom always motivates the speakers, moderators, and the participants. Thank you for your such kind words. Friends, now I move to the main session. We have 2 speakers with us. We will have 2 sessions, and after that, we'll have the question and answer where we'll discuss all the points that you have it. Please try to make this session interactive one by asking as many questions as possible. We will try to take your questions so that our esteemed panel of speakers discuss your point. We have first speaker, Mr. Ranbir Singh Dhariwal. He is the Chief Executive Officer of Max Life Pension Fund Management Limited. He is a postgraduate in marketing and possesses over 2 decades of experience in life, health, general insurance, including pension and annuity business. Prior to joining Max Group, he has worked in various organizations like HDFC Life, Tata AIG, ICICI Lombard, etc. In his previous role, he was responsible for growing retirement category and heading NPS government business. With this brief introduction, now I request Mr. Dhariwal to take his session. Sir, over to you. Roughly, you have 45 to 50 minutes. It's all yours. Thank you.
Thank you. Thank you, CA Hemraj Joshi, and thank you, CA Charanjot Singh Nanda Saab, for all your words. It's a Saturday evening, and we try to keep it as interesting as possible. So we have made a short presentation for this seminar, and we hope to keep it as engaging as possible. And I look forward for all your participation. So here we start. So National Pension System for Retirement Planning, that's the topic. And I'm very personally very passionate about retirement as a subject. So before we get into NPS and understand NPS, it was important for us as an organization, as a company, to understand where does India stand when it comes to retirement readiness. There have been a lot of reports, there have been lots of studies, but we took a lead, and we had our own retirement study that was India Retirement Index, and we recently launched the two. And we would like to quickly share some snapshot, high-level snapshot of this study. This was done in Metro, Tier 1, Tier 2. More than 3,000 participants participated in the study. And the outcome of the study, I hope the screen is visible for all. So the outcome of the study, I'm sure, will make you start thinking if you have not already started thinking, and make you start advising if you have not already started advising, your clients. So some of the study findings are very shocking here. 1 in 3 Indians believe, that their savings will exhaust in 5 years after retirement. Now that's a big number. So what are we doing about this? Almost about 80% of the people, they believe, who are in the age of 50, that they should have started early. They regret not starting early. That is another big area. It is already too late. 4 out of 5 people believe that, they will have a very healthy and fit life during retirement. Yet 70% of them don't take any action. 67% of the people, they actually believe that life insurance is there for their retirement. That's the best suited product. However, only 30% actually invest. Now, these are some of the questions, that we are aware. However, we are not acting, or if at all we are acting too late. So what happens when we act a little late? What is the cost of delay that happens? Now, imagine a 28-year-old person who joins in after doing a graduation, post-graduation, or have settled a couple of years in the job. If that same person invests about 5,000 rupees right from day one for the retirement, at the end of 60 years, that person would accumulate about 1.27 crores. And look at how it starts dropping. When it comes to 30, it is 1.04. When it comes to 35, it comes to 62. And when you are in 50s, it comes to about 10 lakhs only. We have assumed 10% interest rate here. Now, what is the cost of delay? For example, if you assume that you want 1.27 crores on retirement, if somebody is targeting 1.27 crores on retirement, and if you start at the age of 40, instead of 5,000, you would end up investing 18,000 a month. If you start in 60, you would end up investing 65,000 a month. Now, this is what happens, when the amount increases for investment, we tend to delay it further because we believe that most of us cannot afford 65,000 going in for retirement every month. It takes a huge amount, from the take-home salary that we have, which is why, we should start early. Be smart and you start early. Now, how does NPS, is a complete retirement solution, National Pension System, which was launched by Government of India 2004 for the central government employees largely. And then many states adopted the NPS system. They opened the unorganized sector, which was for all citizen model later in 2009, 2010. So So now anybody can actually participate in NPS and start planning for retirement. Now there are lots of myths around NPS. That it does not have flexibility in a product. You are rigid. You are forced. My belief strongly is that we Indian investors, we need to be force disciplined. Natural discipline doesn't come to us. So as long as there is no forced discipline on us, we tend to withdraw the amount. And especially when the duration is 30 years, we have to save for 30 years retirement. There are a lot of distractions that come in between. For example, we may buy a bigger house, we may need some capital for some luxury, and there may be several other lifestyle changes that would happen, which may require some amount of capital. And if it is kept in a highly liquid or available resource, we tend to dig into that capital, whatever we have accumulated, and seldom we go back and again refill it. So retirement needs to be looked differently. It is a long term. So we need, if you're talking about 25, 30 years of savings, which will help you post retirement, we need to have some discipline around that. And I believe national pension system addresses this point very beautifully. Now, this product allows you to accumulate during the earning ages. In case of emergencies, there is an emergency withdrawal facility also available. So it is not that it's a fixed product and you cannot withdraw from this product in between. We'll cover the rules later on. There is a lump sum withdrawal at the time of retirement. So when you are retiring and there is a need for cash, maybe for children's higher education, maybe for building a home in your village or back home, or maybe getting your kids married, there is an option of lump sum withdrawal, which is up to 60%. And there is a compulsory annuitization of 40% that allows you to have a regular stream of income as long as the annuitant and the spouse lives. And whatever is the corpus, which is 40%, is paid back to nominee. So it creates a beautiful legacy, planning as well. And it allows a regular stream of income for your entire life. So you are secured at least that there will be some amount of money that will keep coming to you. So this is how NPS works, and which is why I believe that this is a complete retirement solution. And anybody who thinks about retirement and where to invest for retirement, this is a product which I would highly recommend. And we'll see why do we recommend NPS. How does NPS really work? We'll get a little bit more into detail or in depth about NPS. So like I mentioned, NPS has two models for the audience, which are the relevant model, which is for the audience over here. So there is an all citizen model and there is a corporate sector model. So under an all citizen model, anybody can open NPS account. Anybody. For a corporate model, any corporate can adopt NPS as their retirement planning for their employees. And there are huge amount of perks for the corporates, which I will not be covering this. I'll have my fellow speaker, CA Pinky Agarwal, cover, which is the most exciting topic of this NPS, which is on the tax part. So I'm not touching about the tax, and I purposely, whenever anybody comes to me about NPS, I would like to position NPS as a retirement and not just a tax planning tool. So PFRDA is a regulatory body, and we'll talk about how the ecosystem also works. Like your PAN card, there is a PRAN card which is issued. This is Permanent Retirement Account Number, which is issued. And there is one single number which you can keep moving. If you are in a corporate, you can transfer this PAN account to a corporate. If you move out of corporate, you can transfer it back to an all-citizen model. So very transparent, very user-friendly, and very easy system to operate in. So who all are there? Why do I say that this is an easy, very transparent system? If you look at the ecosystem, there is a pension fund regulatory, which is the regulatory body, the authority. They have also appointed NPS Trust, who manages and controls all the operations under the NPS. Then we have point of presence, which are the distribution point. And from a customer perspective, there is a trustee bank which holds all the money. There is a custodian. From a customer perspective, there are various options available, which is why I say this is very transparent and very user-friendly. You can choose from any of these 10 pension fund managers, where and how or who you would want them to, choose, and who would be actually managing your funds. You can choose who would be your central record keeping agency. There are currently 3. And there are 14 annuity service providers, which are available. So you have an option. This is not a forced scheme. You have an option. You can do a study, and you can see in the newspaper on Wednesday, on various articles. You will get all the information when you go to a NPS Trust website on what are the current annuity rates that are going on, what are the pension fund returns that are going on. So completely transparent system available, and you are in complete control because you have an option to choose from your fund managers or the CRAs or an annuity service provider. So this is how it works. What are the investment options available under the NPS? Before we go into the investment options, we need to understand there are 2 types of accounts. So it is not just a retirement planning tool. I strongly pitch this to everybody, saying that this is an excellent wealth creation opportunity as well. And why do I say that? So under NPS, there are 2 types of accounts, tier 1 or tier 2. Now, tier 1 is a default account, which has, the entire accumulation. Then you have these partial withdrawals and mandatory annuitization built into the tier 1 account, right? And it also has various tax benefits, which will be covered later on. The tier 2 account is more like a wealth creation account. So instead of saving your money with any mutual fund or any other place, you can look at NPS for your wealth creation as well. You can choose what amount you want to invest. You are free to withdraw, contribute any point of time, any amount. Minimum contribution obviously is 1,000 rupees during account opening, and thereafter 250. Extremely flexible. The biggest and the largest advantage, which all of us understand, is the fund management charge under NPS. So if you actually see, there have been various studies by the regulatory body, and the approximate cost of having your money in NPS, the charges which are deducted to you, we have a charges slide as well, comes to about 10 to 12 basis points. That is all. That's the only charge which the customer will be paying. So absolutely transparent, low cost product. The tier 2 account helps you to create your wealth, and you can come in and go out any point of time. Tier 1 is a default account which has inbuilt pension built into it and several tax benefits. The minimum contribution at the time of account opening is 500, and minimum contribution is rupees 1,000 in a financial year. So this is tier 1, tier 2. These are 2 types of accounts under the NPS. Again, like I said, this is a transparent system. It gives you great amount of flexibility. It also allows you to choose what kind of investment approach you would like to take. So there is an auto, there is an active. Auto is largely, it is automatically decided. There are 3 types of funds which you can choose from. And the money is divided according to the type of fund that you choose in equity, corporate bonds, and government securities. And as per your life cycle, the exposure on equity keeps reducing. We have a slide on that we'll show you. So for any investor who's not, and we have seen majority, about 80-85% of the NPS subscribers, they go for auto choice, because many of us may not understand the financial market as as in depth as any one of us would want us to be. So it's best that you choose an auto and let the scheme decide what is good for you. In an active choice, these are more evolved customers, more evolved subscribers. They decide what is the amount of exposure that they would like to have, and accordingly they choose ECG and A exposure, which is the alternate funds. We will come to those in detail as well. Now, again, if you choose, let's say you want to go for auto choice, you are allowed 4 times in a year without any cost to change your scheme, change your asset allocation, which is why I keep saying extremely flexible and allows you to change your investment patterns 4 times in a year without any extra cost. Right? Now, what are the types of funds in NPS? G are government bonds, low risk appetite, low returns, government securities. C is corporate, which is moderate risk appetite, moderate returns. E is equity, high returns. Maximum investment up to 75%. And A, alternate bonds, which are alternate investments, which are capped at 5%. So very high risk appetite, very high return. So that's how these types of schemes which are available. So I was talking about auto choice. Now, since this is a retirement product and somebody who has opted for a retirement auto choice, the system understands that, one may not be as comfortable and as active in deciding what is right and how to keep changing these asset allocation, which is why it is already inbuilt into the NPS scheme, where with age, the exposure to equity keeps dropping. So for example, if you are in 75% of aggressive equity allocation, by the time you reach 45, your equity exposure would have reduced to 35%, and your government securities and corporate bonds keeps increasing. So it adapts to your life cycle so that when you're coming closer to your retirement, there is less exposure to equity. There is stability in your funds, which allows you to plan your retirement accurately. And this is, mostly the most preferred option, that we have seen. And this is for people who doesn't understand or doesn't study and wants to leave this opportunity for investment to, in the hands of the system and the pension fund manager. When it comes to active choice, 75% of assets, can be in equity. That's max limit, that is there under the active choice, which means you are in control. You decide when you want to reduce your equity exposure. The max limits are set. You can choose that you want to be 100% in government bonds. You can choose you want to be 100% corporate bonds right from day one. Or you can choose that you want to be max 75% exposed to equity. There has been recent changes, to the investment guidelines. And this allows you to now continue with this 75% equity exposure even after the age of 50, which was not there earlier. So even after the 50 years, when it used to earlier start tapering down the equity exposure from 75%. Now there has been amendments, and one can continue to be in the 75% equity exposure even after the age of 51 years. Okay, this is on the active choice tier 1 account. Tier 2, max limits are set. You can have 100% equity. Like I said, this is an extremely low cost wealth creation tool that can be looked at from a tier 2 account. It is mandatory to have a tier 1 account to open a tier 2 account. You can't just have a tier 2 account. So it is mandatory to open your tier 1 account first, and then you can open your tier 2 account. It is very, very easy. It can all be done online. So as we were talking about flexibility, this is one question which keeps coming to me, that, I don't want to block my money in NPS. There's no flexibility. It forces me. So there are emergency withdrawal provisions under NPS. So one can withdraw 25% of self-contribution. That is maximum 3 times from your NPS corpus. after completing 3 years in the system. So this allows you, and it is a flexible investment that you are making. It allows you, and there is a provision that in case of any emergency, mind you, this is a retirement product. So the objective is that you create a large amount of corpus when you retire. However, PFRDA, NPS Trust, while forming, they understand and realize that there can be life emergencies, or life stage changes for which there may be some emergency fund requires. And some of them are, the reasons are mentioned below. For these reasons, you can withdraw up to 25%, which is higher education, marriage of children, treatment of specified illness, purchase of residential house or flat, or establishment of own venture or any startup. So it does allow you flexibility. How do you exit? What happens, under NPS? What is the end state of NPS? So if you look at the end state of NPS, so there is a premature, exit allowed. The premature exit is 100% of lump sum can be taken if the corpus is equal to or less than 2.5 lakhs. So you start to invest in NPS, and for some reason you decide that you don't want to continue. If your corpus is less than 2.5 lakhs, you can withdraw 100% of the money. If the corpus is greater than 2.5 lakhs, then 80% of the accumulated wealth has to be utilized for purchasing an annuities, which will give you pension for life. And then balance 20% is paid to the subscriber. This is for in between premature exit. What happens on superannuation? Now on superannuation, this limit increases if the corpus accumulated is less than 5 lakh rupees. Then you can withdraw. You have an option to withdraw complete amount as a lump sum amount. 100% can be withdrawn if the corpus accumulated at the time of retirement is less than 5 lakh rupees. If the corpus is above 5 lakhs, as mentioned earlier, 60% of that money can be taken lump sum, which will be tax-free in your hands. And 40% will be invested into annuities, which will again be tax-free, 40%. However, the income that comes from the pensions, the annuities, will be taxed. So basically, 60% in hand, 40% into annuities. In case of death after 60 years, superannuation, lump sum is paid to the nominee. However, the nominees can opt for annuity if they desire so. Okay, so in case of death, 100% will be paid to the nominee. Exit due to death, the entire accumulated pension wealth, whatever is accumulated, is payable to the nominee or legal heir if the subscriber dies before or after attaining 60 years. However, there is an option for the nominee as well to start a pension if they desire so. These are the exit norms from NPS. Now, there are people, and there have been a lot of queries coming in saying that, I would like to work more. I would not like to retire at the age of 60 because I'm into business or I start consulting. Now, there is an option to continue to stay invested even after retirement age. There is an option of deferment, and one can choose to defer till the age of 75 years and also continue to deposit money and contribute to the NPS so that the corpus keeps increasing. Now, this is the option available. In case if the subscriber has not initiated exit at the time of superannuation, the account is continued till the age of 75 automatically. Now, that doesn't mean the subscriber cannot exit after that. Subscriber can exit from NPS and start pension anytime during the deferment period. So you decide that, at 60, you want to continue till 75, but at 67, you decide that, boss, I would like to start availing my pension. You can exit and you can start your pensions at that point of time. Subscriber can opt for deferment up to 10 years. So for example, you decide not to continue to invest and you want to defer the lump sum amount that you want to take, you can do that for up to 10 years. Annuities can be deferred. For example, you choose that I am taking the 60% lump sum at the time of this, retirement. However, I don't want to start my annuities today. So you can defer that annuity starting 2-3 years. The money will continue to be in your NPS account, continue to stay invested, continue to grow. And after 3 years of taking the lump sum amount, you have to start the annuities. So these are the options available on deferment or extending beyond the age of 60 years. Now, what happens? What are annuities? What are the annuity options available for NPS retirees? Now, once superannuation age is attained, 40% of your money goes into annuity. And what are annuities? Annuities is nothing but a pension that gives you income for life. The most popular annuity option that we have seen is joint life with return of purchase price. What happens in this? Very simple example is shown here. So after the age of 60, let's say one decides to start the annuity option and you are receiving the annuity income, which is a pension in the form of pension. And at the age of 80, the primary annuitant who was receiving the pension passes away. The secondary annuitant, the spouse of the primary annuitant, will continue to get the same pension amount till the time the spouse is alive. Let's say if something happens to the spouse at the age of 90, the entire purchase price, which is a 40% mandatory annuity purchase price, the corpus, is written back to nominees tax-free. Now, this is the most preferred annuity option that we have seen people taking. This is the most popular annuity option. In this, you have a without return of purchase price, where the pension continues for the primary and the secondary annuitant for life. Upon death of both the annuitants, the pension stops. Nothing is paid back to the nominee. So this is a least preferred, or I would not say least preferred, but less preferred annuity option. Without purchase price is a less preferred annuity option. Approximately, if we see in the industry, about 2.5-3% of the people, they go for without return of purchase price, while it is purely as per your requirement. If one likes to believe that my kids are well settled, they're abroad, they don't need my money, you can go for without return of purchase price. However, we have seen close to about 97-98% people going for with return of purchase price. So we saw a joint life there. Similarly, we have a single life where the primary annuitant continues to receive pension for life, and upon death, the money is paid back to the nominee. That is single immediate annuity with return of purchase price. In that option, we also have without return of purchase price, where the primary annuitant, the single annuitant, continues to receive pension for life, and upon death, nothing is paid back to the nominee. So these are the annuity options available, and there are several more, but we have only covered the most popular one, which is the return of purchase price, joint life, and single life. There are many other options available. One can choose to take which annuity option is best suitable for your requirement at that point of time, and accordingly go for your annuities. Now, charges. What are the charges under NPS? Now, the charges under NPS, if you see, the account opening charges, minimum 200 to maximum 400 rupees. That's the charge allowed. That's the range one would pay. Further to that, the contribution processing, like for every month, if you decide that you want to do an SIP and you're doing 5,000, 6,000 rupees, the contribution charge is 0.5%, subject to minimum of 30 rupees and maximum of rupees 25,000. The charges are defined there. For non-financial transaction charges, which are any kind of charges for availing any services, for nominee change, address change, or any other services, if done through physical transaction, then there is a charge of 30 rupees for per non-financial transactions. There are services available online, and one can do a lot of these non-financial transactions online as well. Now, what is the pension fund manager fee? What is the fund management charge under NPS? Now, this has also been decided as per AUM slab. So any fund manager which is less than 10,000. So for the first 10,000 crores of the AUM, the charges are 9 paisa, which is 0.09%. And 10,000 to 50,000, it is 0.06%. 50,000 to 1,50,000 is 0.05%. And for 1,50,000 crores of AUM, it is 0.03%. BFM charges are recovered on daily basis by adjusting the NAV. That's how the charges are adjusted and recovered, which is where I was saying very fair, very transparent, low cost product, and that can be seen. And that could be another reason where it is not getting the popularity as it should. However, I strongly recommend and believe that this is the right product for anybody to plan for the retirement, and this should be always discussed and given as an option for anybody who's coming and taking any financial advice. The other charges, which are led by the CRA, are PRAN generation, which is fixed at 39.36, annual maintenance of 57 rupees, financial transaction processing at 3.36, and NPS trust, which is the trust, who takes care of the trust management charges are 0.005%. So it is, you can always, you can see the charge; they are always negligible. All of these charges, they are by cancelling units from your, NPS account on quarterly mode, and custodian and NPS trust charges are recovered on daily basis by adjusting in the NAV. So this brings me, to the closure of my product. So my objective was, this is a product which is not well understood, and I wanted to throw some light on the product. The highlight of the product, which will be spoken by my fellow speaker in our next session is on tax, and that's where I would like to leave this with all of you as we move into the next session, that this is one product which is a EEE status. At your investment, it's a tax exempt. During your accumulation, it is a tax exempt, and at the withdrawal, it is tax exempt. There is a limit of 7.5 lakhs, which is the cap. However, as per the study or the data that we have seen at the corporate level, almost 80% of the people, 85% of the people, they fall under, a complete EEE, tax benefit. So enjoy the 3E tax status with NPS, and enjoy your healthy retirement, fit retirement, and a wealthy retirement with NPS. That's how we would like to conclude, and thank you for the time provided to us. So with this, I come to my session's end. I hope we've given you clarity on the product as much as one would like to hear. And there are any questions, we are here, and we will address all the questions, I understand, at the end of the show. And with this, Hemraj, back to you. Thank you very much for the time given to us.
Thank you, sir, for such a nice session. You covered the product in detail very well, covering the various investment options, tier 1 account, tier 2 account, talking about the investment options available, auto choice, active choice, what not. Really, really great. Thank you for this. But this is not the end of this show. We have second speaker with us, Dr. Pinky Agrawal. She is a chartered accountant by qualification with a doctoral degree in commerce, having post-qualification experience of almost 25 years with profound knowledge in financial reporting, accounting, and taxation. She has conducted many training programs and workshops on securities market, financial planning, and tax planning. Currently, she is associated with ITM Group of Institutions, which is a multidisciplinary B school, as a head of finance department and Center for Policy Studies. With this brief introduction, I now invite my chartered accountant colleague, CA Pinky Agrawal, to share her knowledge on this important subject. Ma'am, over to you. You also have roughly 45 to 50 minutes to cover your session, post which we will have the question and answer session. Just for information, rough nearby 1,000 participants are attending this session, and believe me, there are many questions are asked across India now on this important topic. So people will throw some good questions on you, and definitely we will discuss that. So over to you, ma'am, for your session. Thank you.
Good evening, everyone. And I really thank Hemraj ji, Dhariwal ji, Nanda ji, and the committee of our Capital Market Investment Protection. So here, actually, this NPA, as rightly said by Dhariwal ji, it's still where people are not aware. Complete awareness needs to be created for National Pension Scheme, which the government has actually introduced. And he has covered the part, means beautifully, he has covered all the parts, how we can avail the scheme. All the intricacies has been explained by him. I've been allowed to actually give a brief of the taxation benefits of NPS. So let me just share my screen. So as just a quick recapitulation of whatever Dhariwal ji has said, it's like in this VUCA world, we are actually staying in the VUCA world where we have come out from COVID-19 pandemic. And I never thought I'll come back again. The life will become stable. So in this VUCA world, really retirement planning is a must. Many people suffered and they died, their families suffered. So we need to have certain planning in this VUCA world. So V for volatility, uncertainty, complexity, and ambiguity. So I just want to start my presentation with so many people spend their health gaining wealth, and then they have to spend their wealth to regain their health. So in order to be cautious, we need to be very, very proper in our personal planning. So retirement planning is the most important thing which one should do. And we always follow 80-20%. That means 20% should mandatorily be saved for the future. We can curb our necessities, the present consumption, but if we follow this 20% saving for the future, we will never face any uncertainty. So basically, retirement planning is setting up a goal for retirement. So I have asked many people, many clients also, कि you should plan for your retirement. They always say, "Kya, madam? Abhi to just we have started earning, and why we should plan for retirement?" So I just tell, okay, you are used to with the standard of living. You love to party, all this, and we want to continue during your old age. Please do your retirement planning. So I have seen my parents and others, old age people, they have learned how to sacrifice their consumption. They always sacrifice. They're dependent on their children. A lot of health issues and a lot of related expenses due to health issues they are required to face. But I always believe that no, we should not be dependent on our children, and we should live the same leisurely life as we are living now. And I have really made a lot of retirement planning for myself also. So this new pension scheme, it is treated as pension nahi, ye pran hai. And of course, this is a pran, and we have to follow this. So National Pension Scheme, as this was already covered in the earlier session, is just a brief recapitulation. It can be opened online also. You don't have to go and personally and open that account. Very low cost, and you can choose from active or auto, any scheme you can choose. And there are a lot of asset classes, equity, bonds are there, alternative investments are there, 4 classes out of which you can choose. You can do partial withdrawal. Lock-in period is for 60 years if you are going for tier 1, and tier 2 you can withdraw And eligibility is 18 to 60 years. So we have two scheme, tier 1 and tier 2. Of course, tax benefits are always in tier 1, not in tier 2. So this is again NPS in short, all the briefing which was done by Dhariwal ji ki how we can contribute in tier 1, tier 2, the minimum contribution, the portfolio we can form, and the cost, the management, maintenance charges, all these were already covered earlier in the earlier session. So what kind of returns you can expect from means a senior citizen can expect from this tier 1 scheme? So here, if you join, say, NPS scheme, you will get, so you have the facility of withdrawal. That means 25% can be withdrawn during the tenure, or at the time of maturity, you can withdraw 60%. 40% needs to be mandatorily invested in annuity. This is all about tier 1, which you are opting. Tier 2 can be opened only when you have tier 1 account. So here they have a normal exit. So after 3 years, you can of course exit from the NPS, and you can do this. So after completing 3 years, you can exit from NPS. Entire corpus can be paid to the subscriber's nominee if the subscriber dies. And we are going to cover in the next slides the tax benefits. So already covered this. What are the so in short, we can say the benefits of NPS is it is done voluntarily, very simple, flexible, like active and auto, portable and regulated. So it is not prone to any you can say uncertainties. It is properly regulated by PFRDA, and you are safer in this investment. This is as per, so etmoney.com. These are top NPS fund managers in India, and you can go for any of these. So Aditya Birla, HDFC, ICICI, Kotak, LIC, SBI, UTI, and of course, Dhariwal ji belongs to Max Life. That is also one of the top fund managers in India. So let us see the tax benefit for salaried individuals. So what happens? We need to remember only 3 sections and nothing else in NPS: 80 CCD 1, 80 CCD 2, and 80 CCD 1B. These are the 3 sections. If we remember, these are the 3 sections amidst which you get the tax benefits of NPS. So 80 CCD 1, it's actually just we need to remember that 80 CCD, even though it provides 1.5 lakhs for the investment in NPS, but it is subject to 10% of salary, basic plus DA. But 80 CCD1 needs to be clubbed with 80C, and it is not actually separately done. So 1.5 lakhs, it is a combination of 80C, 80 triple C, and 80 CCD1. So the basket of 80C is inclusive of 80 CCD1. So if, say, supposing you have not exhausted your 1.5 lakhs, say you have not invested in provident fund or home loan, Sukanya Samriddhi scheme, equity linked savings scheme, you have not exhausted your 1.5 lakhs. You can go for NPS and exhaust full 50,000. Next, what happens? Now, if you have exhausted 1.5 lakhs, you still have the option to invest furthermore. So, ye bolte extra bonanza. You have further facility or benefit of investing extra 50,000 for NPS 80 CCD 1B. So in totality, you are getting 2 lakhs ka deduction if you go for NPS. So even if you are not going for any other, say, tax investment, any investment scheme, you can invest in NPS in total 2 lakh rupees if you want. But of course, it is not advisable because we, as rightly, so we should not invest, bolte na ki we should not invest all our eggs in one basket. So that is why 80C should be exhausted with different investment options. And of course, you can separately go for NPS 50,000. But again, as I mentioned, 1,50,000, first you have to exhaust 1,50,000 under section 80 CCD 1, 80C, 80 triple C. Then only you can get that extra benefit of 50,000 under 80 CCD 1B. So tax benefit, this is for salaried individual. And of course, when we are going for the investment in NPS, we need to look for that 10%. This is a mandate requirement. Now, if we go for self-employed individual, if they are not salaried, Of course, they also have the same benefit. They can avail 80C, 80CCC, 80CCD1 and exhaust 1.5 lakh. But again, subject to 20% of gross annual income. Apart from that, they can again take the extra bonanza, that is 50,000 by investing in NPS, and they can claim the tax reduction under section 80CCD1B. So we can see that more or less salaried employed and self-employed individual, they get the same benefit, that is 80CCD1 and 80CCD1B. They can exhaust 1,50,000 plus 50,000 is the tax benefit which they can avail. Now let us see what are corporate NPS. So who can join corporate NPS? Any person who is enrolled for corporate NPS, their age can be 18 to 70 years, Indian citizen, even NRI, and they should be compliant with KYC norm. Now this data is from HDFC Pension, but if we see the site at nptrust.org.in, this is the actual data given. What is the present condition? Who are the present status of the subscribers to NPS? So right now, if we see corporate sectors, the number of subscribers are 16,60,304, and this data is from February 23. This is the actual data, and total contribution they have done 86,000 nearly, and asset under management is 1,13,603. So you can see huge increase in the the subscribers for NPS, and people are going forward. Now, if you belong to corporate NPS, what is the benefit what is the tax benefit for the corporates? So what happens? This is very interesting benefit, we can say, for the corporates. Of course, they need deductible expenses, more deductible expenses, less tax they need to pay. So they can show their contribution towards NPS, but it is subject to 10% of salary, basic plus DA, and it can be deducted as business expenses. So for corporates, they can show this as deduction as business expenses, but the maximum amount is 10% of salary. Now the employee, what about the employee who are, say, the employees of these corporates? How they can avail extra benefits? So bolte na, dil mange more. So extra benefit 80CCD1B. Now they want more deduction because they are actually under the maximum MMR, maximum marginal rate of taxation. They are under this, so they can avail more extra benefit for NPS by requesting their employer to invest in NPS on their behalf. Now this will be additional tax benefit, and what they can do, they can request their employer to invest 10% of their salary in NPS, and this is a separate section 80CCD2, and this they can do, they can invest up to 7.5 lakhs. So what happens? They are getting deduction, of course, 1,50,000, 50,000, and as well as 10% of salary, that is basic plus DA. So here, what is happening in totality? They are actually enjoying the tax benefits under NPS under 3 sections. So these 3 sections, if one remembers 80CCD1, 80CCD subsection 2 and 80CCD subsection 1B, these 3 can create a really great, means you can say tax benefit for an individual, for an employee. So all these, if followed, that it can really create. So let us just give one detailed illustration how it can be availed. So just, it's a small example without NPS and with NPS, how an individual can save the tax. Very small illustration. So here, say supposing an individual is having a basic of 20 lakhs and he's getting a facility of HRA 10 lakhs, and say other allowances without NPS, he's getting 17,60,000. Now he requests his employer to just take out 2 lakhs because your 10% of basic is of 20 lakhs is 2 lakhs. And he requests his employer, instead of giving me other allowances, 17,60,000, please give me 15,60,000, and the remaining 2 lakhs should be invested in NPS. So what is happening? Here, the other allowances will get reduced by 50 lakh 60,000, but NPS contribution by employer 80 CCD2, he can avail for 2 lakhs. So what is happening? His total salary remains the same 50 lakhs, but his taxable salary will get reduced. And we can see this, he will get deduction not only under section 80C, say supposing he had employees contribution to RPF also, so he's getting that contribution 2,40,000. Apart from that, he can avail 50,000 under section 80 CCD 1B and 80 CCD 2 for 2 lakhs. So what is happening? Extra, he's getting 2,50,000 deduction if he's availing NPS. So what is happening? Total deduction without NPS is 3,90,000 only. But if he's availing NPS, the total deduction will be 6,40,000. So what is happening? His taxable salary get reduced. So we are always interested in reducing our taxable salary, paying less tax, and enjoying more our hardcore earned money. So what is happening? His taxable salary without NPS becomes 46 lakhs 10,000, and with NPS it is becoming 43 lakh 60,000 only. So the differential amount is 2,50,000, and if we calculate the tax benefit, that is, we are saving in total 75,000 if we are investing in NPS. Just by two section 80 CCD 1B, 80 CCD 2, we are saving 75,000 tax. Now, as a finance person, we are all hailing from finance background. As a finance person, if we calculate ki 75,000 ka corpus, how much it will give? So total tax save. So if we say, we are all say, supposing I am at the middle age, so middle age or 30 saal or GA agar, so of course we will be having a corpus of 22,50,000, 75,000 if saved every year. But of course, we actually always compound our amount. We don't go for the natural or say normal calculation. Okay, 75,000 into 30 years, it should be compounded. Say if I compound it by 10%, my additional corpus will be standing at 1 crore 35 lakhs. Boom. Okay, so what happened? I'll just give you one example. Say when I was going for my CA course, one of the person I met him and he told me, if you lose, say supposing if you're not clearing CA final in first attempt, you are losing 6 months. And he showed me the calculation of 6 months ka loss of money. Like 30 years mein itna loss of money. And I was so shocked. Matlab main itni tension mein aayi, and I just cleared my CA final in first attempt. I thought me itna loss main nahi bear kar sakti ki I cannot lose so much money by just not clearing the CA final test. So here it is like this, ki, okay, if I am not saving my tax, always just imagine the time value of money, the you can say the future value of money, which you will be actually, you may have saved if you would not have availed this NPS ka tax benefits. So this will give you a clarity. Okay, no, we need to avail the tax benefit by just opting for NPS. That's it. Now, this is another example which actually gives a clarity how you can avail all the three exemptions, that is Provident Fund, superannuation and NPS. This three, if like the government came out with this should not exceed 7.5 lakhs. And if the total investment in these three exceeds 7.5 lakhs, of course, it is taxable as a perquisite. So this is again a small example how it will be taxable as a perquisite. So these are different salary structure, 28 lakhs, 57, 143, and it goes on till 85 lakhs, 71,429. These are different tax structures. And if say supposing I just consider 35% of gross salary as my basic plus DA. So what happens? These are the amounts 10 lakhs till 30 lakhs. These are my basic plus DA, 35% of the gross amount. And we need to consider my PF and superannuation NPS contribution should not exceed 7.5 lakhs. And this is a calculation how it shows ki as soon as it exceeds 7.5 lakhs, it gets taxable as a perquisite. So we can see in the first instance, my provident fund, which is of course 12% of basic plus DA, it is coming to 1,20,000. Superannuation, I'm just considering 1,50,000. And NPS, of course, 10% of your basic plus DA is contributed. So in the first instance, it is coming to 3,70,000. Of course, it is lower than 7.5 lakhs. Nothing will be taxable. And it goes on. We can see that when we reach to 78 lakhs ka scale, we can see that my PF, it's coming to 3,30,000, 1,50,000 superannuation, and 2,75,000 is your NPS. So now in this case, it is exceeding 7,50,000. So in this case, what is happening? 5,000 is taxable as a perquisite. And as we go on, as the salary increases beyond 78 lakhs, you can see it gets taxable. So you can enjoy your salary, the exemption part, till 78 lakhs. So 78 lakhs ka package with all these three exemption up to 7.5 lakhs, it's a really huge amount. So we can see that the employer's gross salary, if it is less than 78 lakhs, they can continue to take tax advantage of all the three retirement products. And we have already noticed that retirement must be planned at the young age. As soon as you plan for your retirement, your life gets set. So all these three retirement products you can avail till 78 lakhs ka package. And of course, this varies from gross salary. And you can reap the benefits of your retirement. So here you can see 98% of the employees can be benefited because 78 lakhs is a huge package. And we Indians falling in the pyramid, lower pyramid, 78 lakhs, long way to go. And we can enjoy our retirement products. So just again, we should be very careful that tax benefits are applicable for investment in tier 1 account only. So here, whenever we are investing, we have to be very careful. We should not feel, because when you open that NPS account, you are given an option ki tier 1 ki tier 2. Always remember, tier 1 mein you get the tax benefits for investments. So here, first of all, you should avail tier 1 account only. Now, other tax benefits available under NPS. So these are the other tax benefits. So we have covered ki when we are investing in NPS, what are the tax benefits, how we can avail the tax benefits, and the maximum amount which we can avail. Now, during the exit time, what will be the tax benefits? So as rightly said by Dhariwal ji, ki we can do partial withdrawal. So we are allowed to do partial withdrawal because of certain reasons. Say you want to go for the marriage of your children, education of your children, or any illness, or say for the construction of the house. All these are retirement products only. So you can, of course, withdraw amount from the NPS. In tier 1, you can withdraw only after 10 years. So that is a criteria. And partial withdrawal, when you are withdrawing partial withdrawal 25% before the age of 60, that is, the withdrawal age is 60 years. So if you withdraw before the 60 years, you can withdraw only 25%. And that 25% is fully exempted from tax. So this has already been covered in the first session. Ki triple E we are enjoying when you are investing, exempted. So it is like earlier we used to say, okay, Ekta Kapoor ka 3 times exempted. So exempt when you are investing. And of course, when it is accumulating, the interest is also, okay, it is exempt. When you are withdrawing, it is exempt subject to certain conditions. So in the case of partial withdrawal, it is exempt only when you withdraw up to 25%. Beyond that, it gets taxable. Again, there is a lock-in period of 3 years. So whenever you invest in NPS, lock-in period of 3 years, you can also withdraw from tier 2. It is like SIP, systematic investment plan only. People go for tier 2 when they feel that we have exhausted all my 3 sections and NPS ka tax benefits we have availed. Let us go for tier 2. Instead of investing in mutual fund, some people feel they can invest in tier 2. So we will cover in one slide also how it is different from mutual fund. So here what happens in tier 2, you get T plus 3 days to withdraw. So now let us go for lump sum withdrawal. You reach the age of 60 years and now you want to withdraw. So up to 60% you can withdraw. At the time of this superannuation age, you can say the age of 60 years, you can withdraw 60%. And when you withdraw 60%, it is fully exempted from tax. But it is a mandate requirement. You need to invest the remaining 40% in the purchase of annuity. So it gets further invested after 60 years, 40% gets further invested and you can purchase the annuity. Again, while investing in annuity, it is not taxable, it is exempted. But when you get the income, when you start getting income from the annuity, it gets taxable as per the normal slab rate. So after 60 years, when you start getting annuity income, it is taxable at the normal slab rate. Of course, normal slab rate, you have already attained the senior citizen slab. So you can get the tax benefit slab rate ka you can get. So on the purchase of annuity, when you are purchasing, it is exempted. And when you are getting the invested annuity income, it is subject to normal slab rate. Now let us know if you die before 60 years and the corpus is received by the heirs. So here entire corpus is tax free. So if before 60 years you are getting the, so here we have already covered in the first session, it was covered by Dhariwalji ki here before 60 years, if the subscriber dies, the heirs or the nominee can get the full corpus if they are going for the purchase of annuity. So what is happening in that case? The entire corpus gets tax free in the hands of the nominee or the heirs. So these are the different tax benefits at the time of exit or before exit of NPS. Next, let us know the NPS versus the other investment option. This is just a simple comparison ki how it is different from other investment option. So NPS may you can just assume that ki, okay, 9 to 12% is expected. Of course, in tier 1, lock-in period is till your retirement, 60 years. But of course, we have already learned that ki before retirement also I can withdraw 25% of the amount. Risk profile, of course, it is subject to market return, market-related risk. But generally, it is treated as safe because the portfolio managers who actually operate this NPS, they hail from a very good background and they are very much educated, expert, and they are appointed by the government. This is also one of the opportunity we can say for CAs, which we will be covering in the next slide. Equity links saving scheme, of course, we always feel that this is the best investment opportunity for, of course, aggressive investor. जिसके पास बोलते हैं ना जिगरा है, who can invest in equities, of course they feel that okay, yeah, so for aggressive investors 10 to 12%, lock-in period is 3 years, and of course it is market related risk. PPF 7 to 8%, of course always it is guaranteed and it is always risk free. Lock-in period is 15 years. So after so those who do not feel ki we should not take a risk, they should of course go for PPF first and then they can go for NPS. But FD for me, I always say ki, it is means when if you're investing in something, it should be triple E only. It should not be taxable at certain point of time. So interest on FD gets taxable. If you are investing in FD, what's the use? And again, lock-in period is 5 years. So I always feel that ki, okay, I always believe jahan pe triple E, O, E, wahan pe, okay, that is the most interesting opportunity. Of course, it depends on the perception of the investor, perception of the people who wants to save the tax. So FD sometimes, for me, it is least preferred investment option. I always feel that. This is again value research taken from the value research. This is a small comparison between NPS versus mutual fund. So we can see that ki mutual fund ka expense ratio is very high as compared to NPS, which is just 0.09%, which was already covered by Dhariwalji in the first session. Ki the expense ratio of NPS is very low as compared to mutual fund. The returns also, NPS more or less if you're going for, say, equity scheme wherein 75% invested in you can say equity, again, mutual fund also gives you options for the asset class choice, same as NPS. So again, it is related to, it is subject to market risk. So more or less, you can see the market return in NPS is higher as compared to mutual fund. This is actual data and taken from Value Research. And consistency also, you can, if you just notice that ki consistency maybe it is more or less NPS is soaring high. So if you compare, so who feel that, we have already covered that ki with a very small amount you can open NPS account, and also mutual fund can also be opened with a very small amount. It is up to you, whichever option you feel that is okay. So only mutual fund, maybe equity linked savings scheme is you can avail 80C ka deduction. But in NPS, you are availing, actually, we have already noticed that we can save nearly 2,50,000 by just going for NPS. So it is just a comparison ki whichever option you feel that you can go for it. This is again a small comparison between equity linked savings scheme as compared to NPS. I have already mentioned that key equity linked savings scheme generally is for those people who are aggressive investor and who are, you can say, ready to take risk, whose risk appetite is very high. They only can go for equity linked savings scheme. So that is the most important thing. Ki what is your risk appetite? So based on your risk appetite, you can go for it. Of course, in any way, in any day, you can say the returns in equity linked savings scheme is always higher because it comprises of only equities, primarily equities, we can say, and they can reap higher returns as compared to NPS. But of course, everyone should feel that ki what is my risk appetite, and accordingly they should choose the investment option. Now let us see. So we are coming to an end of our session. This is the professional opportunities for CAs. You can go for if you want to go for employment, say in NPS, you have the option of giving an exam conducted by NPS. So 4 papers you have to sit for, 400 marks ka paper hai. You can either go for officer grade A assistant manager or officer grade B manager. And the beginning salary, that means this is inclusive of all the allowances, perquisites, everything. So basic plus all the allowances and perquisites. And beginning salary for an assistant manager is 23 lakhs. And for a manager, the salary is 27 lakhs. Of course, it can vary. This is just an approximate amount which has been quoted. You can visit the site and nps.trust and you can just sit for this exam. They do require master's degree. So CA is considered in this ambit. You can go for this exam and clear this exam. And this is all. I just want to conclude my slide. Ki retirement is not the end of the road. It is the beginning of the open highway. So happy retirement. Happy every day of your retirement. Plan for your retirement and live happily. Thank you from my side.
Thank you, ma'am. Thank you, CA Pinky Agarwal, ma'am, for such a nice session, nice topic covering the taxation, the return analysis, product analysis part, product comparison, ma'am. You covered it very well. Thank you for that. Before we move to the question answers, and as I am mentioning, we have not only participants across India, but even there are participants outside India also attending this session. So, and definitely I will cover their question as well while I discuss with you. But before I move to question answer, Ranbir sir, just anything, a quick comment from you, still something left for the participants to know about NPS, maybe 5-10 minutes you can cover this.
Sure. So I think the interesting aspect about NPS, and many people do often ask me this question, that 40% annuity, is locked in. Why? And I want to save this for the end. If you would have looked at the various tax benefits which are built into the system, and when we see the amount of money if reinvested from the tax benefit, technically the amount that you are investing in annuities is actually free. So whatever tax that you are generating over a period of time, if you are saving that money and you are reinvesting that money, is absolutely making your annuities purchase free of cost. So when you compare this product against a mutual fund, which is a likewise comparison, I always tell them that, boss, you invest, and we can prove it with the maths calculation, that if you invest it at the same time, same period, because of the tax benefits, the 40% amount is actually coming free to you. So the annuities is free. So it's a no-brainer for us to look at annuities. That is one aspect. Second, people, when they question me on annuities, I tell them that in the world, I can say this confidently, in the world, annuities are the only product which offers you guaranteed return for life. So no matter how long you live, we all believe that, boss, I don't want to get restrained by fixed income. I want to have a flexibility. Yet, as per the articles, during the lockdown, when the FD rates, 2-3 years back, when the FD rates dropped during the lockdown, we saw that more than 4 lakh crore worth of FDs are for senior citizens, and senior citizens depend on FD income for their retirement life. So instead of an FD which is open to a risk of reinvestment, you have this stability which is providing you lifetime FD returns, and there is no reinvestment risk. And more so, I often tell people that don't visualize yourself at 60. We are still active. We have just retired, and I pray and hope that everybody remains active till the last day. But there are lifestyle diseases. Imagine ourselves at the age of 70. We are not as actively, there to manage our investments. So at that point of time, we need a stable income, which at least takes care of my basic expenses till the time I am alive. That's where annuity comes in. And this is nicely integrated into the NPS architecture. And then it completes the overall retirement journey for any individual, where you accumulate, you save tax, and you enjoy a free retirement life. Also, the objective of the slide, which was shown by my fellow presenter, Miss Pinky Agarwal, that about 75 lakhs or 80 lakh rupees of salary, 7.5 lakh rupees is breached. That should not be a deterrent. It still becomes a tax exempt, tax only to the tune of above 7.5 lakhs. Okay, so it is only 50,000, 1 lakh rupees, which is incrementally invested, is getting taxed. So it still remains a tax exempt product, which is still a beautiful product to have at such a low FMC or a management charge. And we've all seen through the research, people want to live a healthy retirement life, yet we are not planning it on time. I suggest that everybody starts planning on time and look at NPS seriously.
Thank you, sir. Now I move to the...
Also, sorry, Emraj, sorry, I'm not cutting you.
Please go ahead, sir.
You mentioned there are people who are also outside India who have connected. So even NRIs can invest in NPS. Yeah. So this is I just wanted to say that. Yeah.
Thank you, sir. Now I move to the last session, last part of the session, which is question and answer session. There are many questions which are asked by the participants, and that probably emphasize the importance of this topic and that too, especially in the March month. We just have 6-7 days now left, to do the tax planning or tax saving. And my all chartered accountant colleagues are, I'm sure, are busy in helping their clients or for self also, doing the exercise. So I move to the question session. But before I ask the participant question, I had one question which I asked to Mr. Dhariwal. Sir, recently few states have moved out of this new pension system, right? My question to you: how do you see this move, and what will the impact for the overall growth of this industry?
So you would have seen papers, various articles, various financial studies. There was a committee which was mentioned. Our earlier finance ministers, all of them have commented on this. It is not good for a state to move into NPS because we just can't afford it. If you look at globally, all the advanced economies, they've all moved away from an OPS to a contribution, from a defined pension to a contribution scheme. So, we simply don't have that much funds to support the OPS. That's my view. However, when you talk about the industry, I still believe if only 1.3 crores subscribers, have registered so far under the NPS, we still have a very long way to go. We have just started. We have to create a pension society. Defined contribution is the way forward. From a fiscal perspective, from any perspective. So I don't see any impact on the industry. However, I see a huge amount of strain on economy if it is moved to an OPS by some of these states. And I believe there are discussions going on. There are right committees. Recently, our finance minister announced that there will be a committee that will be formed and they'll try and find a midway so that at least some minimum pensions are guaranteed to the employees, so that the reservation that they have where we don't have a visibility that what is a pension one would receive, is also addressed. However, my math suggests that if you are 20 years into the service, the amount of pension that you will be getting from NPS will be much larger as compared to OPS. That's my personal view.
Thank you, sir. That summarizes answers my question. I move to the next question. Just long some time, which is from Visakhapatnam, and I'm just telling the name of city, so at least we'll also understand how this session is attended by participants across India. So we have a question from Visakhapatnam, and ma'am, this is question for you, Pinky ma'am. The question asking that how the impact on the taxation will be happening under the new tax regime.
Okay, so if we are availing the new tax regime, we are not allowed to get any deduction. So what is happening if you are going for new tax regime? 80C is not applicable in that. So that is why any day old tax regime is better if you want to go for tax benefits.
Ma'am, I have one follow-up question. Since government in some or other way is promoting the new tax regime, so how do you advise the participants to take the benefit of this product, as for the tax planning purpose?
So what happens? We always feel that NPS we are availing for our retirement purpose. So of course, tax benefit is a secondary factor if we look into that. And if we see the corpus which actually develops at the time of retirement, if we start NPS at the early age, it will be much, much more larger as compared to the tax benefit. But still, government has not made new tax regime mandatory. So till that, and we cannot guarantee also that it will be made mandatory. So maybe till the old tax regime, we can do definitely avail the tax benefits as provided under Section 80C, C, D. We are availing all these tax benefit. But whenever we think of NPS, the corpus which it is actually forming for our retirement, it is much more beneficial as compared to any other benefits.
Thank you, ma'am. I move to the next question, and that is to Ranbir sir. Sir, in the presentation, ma'am covered about the NPS with the mutual fund products, their returns, charges. Do you think in the long term the NPS industry or the NPS product will compete with the mutual fund industry?
Why in future? It is already competing. People see there is a lack of awareness, and which is why we are here, to create this awareness. I'm sure, a lot of participants in this session today did not realize that NPS only has 10 basis point as charges, as compared to mutual fund. If you buy direct, has about 70 basis point. If you buy through, and 80% of them buy through some bank or some middle agent, where it is 2.5%. And clearly, over a period of time, when you're investing for 15, 20 years, FMC plays a huge role in your corpus building. So, I think it's an immediate alternative available for anybody. And like we said, there is an NPS tier 1 account, there is an NPS tier 2 account where you can contribute and withdraw any point of time, any number of time. And avail wealth creation at a very low cost and at a completely transparent mechanism, which is available to you and monitored, governed by Government of India, which is a Government of India product, PFRDA. So I believe, this is a direct alternative already available, and people are, investing in tier 2 for wealth creation.
Pinky ma'am, your view on this question?
So, as rightly said by Dhariwal ji, yes, so if you want to go for systematic investment plan, tier 2 is the best option, you can say. So, those who feel that, no, I don't want any lock-in period and I want to withdraw as per my convenience, they can definitely go for tier 2. Tier 1, of course, we have already mentioned that it is for retirement. We want to live a happy retirement life. That is why we are availing tier 1 facility. So NPS is definitely competing with mutual fund. And mutual fund, the same characteristics are prevalent in NPS. So if you really want to go for any government regulated, that is also regulated by MFI, SEBI, mutual fund, it doesn't matter. But of course, if you really want, I want, beside my retirement planning, I want a flexible plan, you can go for tier 2 NPS scheme.
Thank you, ma'am. The next question is from Muscat, okay, and that is for Pinky, ma'am. The participant is asking, is an NRI eligible for NPS? So this question is covered somewhat, but ma'am, is there any special thing apart from a normal assessee that NRI should keep in mind while doing the NPS, or the rules are exactly same for the NPS, for the NRI and non-NRI?
Yeah, the rules are exactly same for NRI and the resident. So they can avail NPS scheme, subject to our, of course, FAMA Act and other acts, which is applicable for NRIs.
Next question to Ranbir sir. What is the role that brokerage firms can play for the development of this NPS product?
So in the architecture, we did show about POPs, which are distribution of NPS product. So the brokerage firms can become a POP, or they can become a POP sub entity under a POP. For example, I'm sharing, if Max Life Pension Fund is a POP, we can appoint a POP sub entity, who can start distributing NPS, and the charges, whatever charges we have shown for per account opening charges, they are all given to the brokerage firm. The requirement of becoming a POPSE is very, very negligible. It does not, and the POP becomes the face for the POPSE. So all regulatory reportings, all regulatory asks are taken care by the POP. It is just a 5,000 rupees and some simple documentation which are needed by a POPSE. And they can start distributing and start generating revenue by distribution of NPS as a product.
Thank you, sir. Just an update. We have roughly 1,150 participants attending this session across India. Okay, and they are asking questions also on regular basis. And I will convey these questions to you.
Sure.
Next question is for Ranveer sir, and I'm just reading the question, so it is a bit technical in nature. Sir, can we switch to annuity without purchase price from annuity with purchase price, or vice versa?
So when it comes to annuity, we need to understand at the time of retirement, you have bought a return of purchase price annuity as a product. Now, once you decide which annuity product you want to go for, you cannot change the annuity option later in the stage. When you buy an annuity product, you are given a 15-day, 30-day free look-in period where you can review, just in case if you have not understood at the time of buying the complete benefit of the product. You are given 15 to 30 days to look at the product documents that one would have received. And if during that period one decides that I would like to switch my option, I would like to change the option from, let's say, without return of purchase price to with return of purchase price, is allowed, can be done. However, once the free look-in period is over, there are no options to switch because one needs to understand, the investments are made to provide, security for the entire life, and which is why withdrawal in between or changes in between is not encouraged.
Thank you, sir. The question that I asked you, that was from Kakinada. Okay. The next question is from Bhiwadi, and that is from Pinky ma'am. The participant is just asking you to repeat the career opportunities which you discussed in the last few paragraphs.
Okay. So what happens ki if you want to join NPS, say as an officer, you have to appear for the test. So in the government site, there is an option of appearing for test. You have to appear for 4 tests. One is for aptitude, general awareness, quantitative. In this manner, there are 4 papers, 400 marks paper. And if you clear that test, you can sit either for, say, grade A, assistant manager, or grade B, manager. And the approximate salary will be ranging from 23 lakhs to 27 lakhs, inclusive of all the perks. That means the basic plus all the allowances and the perks which they provide. This is the general range of salary which an assistant manager and a manager gets if they want to become, if they want to join NPS as an officer.
Yeah. Thank you, ma'am. Just to add on to this point also, apart from the opportunity as an employee for chartered accountants, there are also opportunities available with the whole NPS ecosystem for practicing chartered accountants as well. Whether it is a internal or concurrent auditor for pension fund management, or whether the internal auditor for POP business, or statutory auditor for scheme accounts, statutory auditor for company accounts. There are a lot of opportunities built for chartered accountants also to ensure the robustness of this ecosystem. I'm moving on to next.
And also,
question.
we are always a tax consultant for NPS. So we can always save tax of our clients. That is the most important thing. We are always advising a client to how to save the tax. So NPS becomes a major source of saving the tax.
Absolutely. And just to add, Hemraj, one can also become a retirement advisor under the NPS architecture, and they can become an advisor with any of the PFM POP company and distribute as well.
Thank you, sir. This is next question from Surat, Gujarat. Okay. And the similar question from Nellore also. The participants are trying to ask the percentage which they can withdraw 60% at the time of retirement. Is it 60% of the total contribution or 60% of the AUM? Pinky ma'am or Ranveer sir, anyone of you can take this question.
So if it's okay, I can take it. Pinky
Yes.
ma'am. So 60% is the AUM and not your total contribution. However, I don't encourage people to withdraw because this is a retirement product. You're saving it for your retirement. So government has still, the scheme has still provided you an option to withdraw in case of any emergency. So up to 60%, not 60%, up to, you can withdraw 10, 20, 30, 40 also. It's not mandatory to withdraw 60%. So up to 60% of the corpus which you have generated, which you have built, can be withdrawn, which is tax-free, up to 60.
Thank you, sir. There is one participant from Hyderabad. He wants to know about the Swalamban scheme. So anyone of you can take this question. Swalamban option.
Sorry, NPS Swalamban option?
Yeah.
Okay. You have to give me some time. Maybe I can come back to you on this question.
No worries, sir. No worries. There is one question, ma'am, from Ajmer. Pinky ma'am, to you. The participants just want to know about the last leg of E. So triple E, she wants to know the last leg of the E.
Okay, so the first E was the investment. Second was you can say the amount every year it is accruing. And the last part E is the withdrawal. That means when you are withdrawing at the age of 60, 60% when you are withdrawing is exempt from tax. But when you are purchasing the 40%, from the 40%, you are purchasing the annuity, that is also exempted. So these are the last leg of exempt key. When you are exempt, annuity. So at the time of withdrawal also, at the time of exit also, it is exempt. But up to 60%, or when you are purchasing the annuity for the remaining amount, that is also exempt.
Thank you, ma'am. It's 7:45, close to 7:45 now. Sir, Ranveer sir, last question to you.
Yep.
How do you see this NPS industry or NPS product in future? Maybe say 5 years down the line or 10 years down the line.
So, this is, in my view, if you look at the NPS future, it is not just going to become the most popular product in the times to come. I think it will take care of a huge amount of burden from the society, where the retirement planning will be much more organized, planned, and there will be enough retirement savings available. So this is socially a very relevant product in my view. And that is reflected in the charges as well. Despite of the low charges, you see a lot of companies, 10 PFM companies, about 333 POPs, who are distributing this product. So there is an effort to, sell or make, I would not call this as sell, but make this product available to everyone. I personally take this as a social cause. So it is going to be very relevant in the future retirement, from a future retirement perspective. And I think it's going to ease off a lot of financial burden from the country as well. If we start moving from OPS to NPS more and more, it gives a lot of breather. And it's eventually the taxpayers' money which will be invested in the right direction. So I think this is a great move. And already the estimates are that this is going to grow significantly. The last 5 years CAGR is about 28% growth. It has already reached, close to 9 lakh crores of AUM. So this is going to, this is a future in my view. And as it becomes more popular as a retirement product, I believe more and more people will also start using this from a wealth creation perspective as well in the tier 2 account.
Sir, I just want to add to it.
Please go ahead, ma'am.
Whenever I used to go for the bank audit, I used to feel, okay, why I have not joined a public organization or a bank where I can get some pension? If I am joining a private organization, not getting a pension. So I think this is a very good initiative started by the government to actually avail this pension facility for everyone. Anyone can avail this pension facility if they are opting for NPS. So as from my perception, my retirement will be safer, and apart from other wealth creation opportunities and other investment planning opportunities, this is the best way I can lead a safer retirement life by getting the pension, that also from the government of India. So I feel it should become popular in the coming years.
Thank you to both of you. And with your kind permission, I would like to move to the last leg of this session, which is the vote of thanks. I really thanks the chairman of this committee on Financial Market and Investor Protection, Mr. Nanda, the vice chairman, Mr. Srinivas. You want to add something, Mr. Ranbir, sir?
Yeah, there's one question which was unanswered on NPS Swalamban.
Please
So
go
I
ahead.
just thought, I will answer. So NPS Swalamban, which was earlier known as NPS Lite, is largely for it's for the low investment, and anybody who does not have a PF, coming in, should not be covered under any social security scheme like Employees Provident Fund or or any other. So basically, it is for the low contributory people who can save smaller amount, extremely less transactional and cost efficient, which makes smaller amount contribution also makes viable. So it is for that segment. And earlier it was known as NPS Lite. Now it is called as NPS Swalamban.
Thank you, sir.
Yeah.
I missed it.
Yeah, no worries.
Yeah. So I really want to convey thanks to the chairman, Sri C.S. Nanda sir, vice chairman, Mr. Kotha Srinivas sir, and all the participants for attending this session, which I think was very useful, not just from the a year-end perspective or the taxing perspective, but from the overall purpose of the retirement planning. I thank first speaker, Mr. Ranbir Singh Dhariwal, and second speaker, Dr. Pinky Agarwal ma'am, for taking their time and enlightening us on this important session. I also thank Mr. P.D. Gevarji, who is from CFMIB committee, for helping us on all the administrative and the operational aspects. Thank you. With this, I conclude this session. Thank you, everyone.
Thank you.
Thank you.
Thank you, everyone.